Hello everyone, my name's Duncan Trenholme and I co-head the digital assets business at ICAP. Today I'll be talking about, and it's a question, crypto, is it just another asset class? So this is the view from a traditional financial organization, ICAP, on how we view crypto. So a little bit about myself. My background, I studied physics originally, and I joined ICAP, which is an interdealer broker, in 2008. So that was September 2008, actually, which was the heart of the global financial crisis. Very interesting time to join a traditional financial firm. Some eerie similarities to what's going on in crypto at the moment. But I spent about 10 years at ICAP working on equity and equity derivatives. And then when we got bought by one of our competitors, Untitled Chapter, we formed a new company, the parent brand called ICAP. And for the last 4 years, I've been working and leading our digital assets efforts. So just to give a bit of background on what we've been doing in crypto, this was the first time that we went public with anything back in 2019. Our entry point was crypto derivatives, facilitating trades on the CME Bitcoin futures products. So that's where we started. A bit of background, whilst today I'm not really going to be talking about ICAP because I'm talking more about digital assets, crypto, and how we view that as an organization. But just as some background to people who may not know, we're the world's largest interdealer broker. Underneath the ICAP group, we have a variety of different brands. Probably the most well-known in the market are Untitled Chapter and ICAP. But we also have various different market brands, including LiquidNet, PVM, which are asset class specific products, as well as consultancy firm, Burton Taylor, and some data firms, Parameter Solutions. So who are we? What do we do? We're a global company. We operate in 27 different countries with over 60 different offices globally, 5,300 employees. Across the world, we run 15 regulated venues, and that's across rates, FX, credit, equities, energy, commodities, as well as now digital assets. So which means, if there is a product that trades somewhere globally, including things like weather derivatives, that's something ICAP facilitate across the globe. And our client base in general, primarily, historically, it's been the banks, but we also have buy-side facing franchise. We deal with asset managers, hedge funds, corporates, market makers, trading firms. But a key point being we are not a retail facing organization at all. So I just wanted to use this time a little to set the scene with financial, energy, and commodity markets in general. What do we mean by that? Because one of the things I've observed in the last 10, 15 years working in traditional finance is there is an increasing level of specialization to an extent that sometimes maybe it's difficult to actually sit back and realize what it is we're facilitating here. So some pretty images taken from Google. I mean, the global financial markets, they're about the exchange of risk and the facilitation of trade across a variety of different assets. So we've got copper, which is part of the metals area, energy, electricity, global shipping, equities, soft commodities. These are all things that are traded across financial markets. Now, to boil it down in terms of what the financial markets, energy and commodity markets are there for, we've got 5 main points here in general, but the first one that's worth discussing is capital allocation. So really at its heart, what we're doing is getting people with money to people who need money. And that in itself, a prime example of that is shares and equities, right? You're talking about the formation of capital around shared ventures. We're also connecting producers and consumers. So in terms of people who generate products or assets or commodities and getting those to people who use them. That's something we see across our commodities markets in terms of metals productions, commodities productions, and then ending up in the hands of end users. But we're also facilitating commerce and trade. We're enabling firms and organizations to conduct global trade and to enact commerce. But also, we're talking about risk management. So if you are a producer and you are producing some form of commodity, you want to be able to manage your risk. There's market volatility. You may not be producing on the same time scale. You may want to hedge your price if you're producing and you know that you're going to be producing within the next 6 months or a year, but you want to lock in a price now. And that's where derivatives markets grew from in terms of hedging future production. And ultimately, all of these things, particularly in capitalist economies, are about facilitating economic growth as a whole. Now, financial markets have not been static, and they have changed throughout history. This is the Dutch East India Company, often thought of as the first example of a joint stock company. 1602 was when it was formed, and out of that grew the Amsterdam Stock Exchange in the Netherlands. Another picture taken off Google, but this is the 1960s New York Stock Exchange, where these types of financial products were exchanged by open outcry. Paper tickets, people shouting bids and offers at each other, and then a whole system of paper trail afterwards where trades were reconciled, exchanged, and we often did this over long settlement periods, so T+5, T+7, where we make sure that the books and records of what has been traded across financial markets match with what actually happened on the day. Now, technology has played an important part in financial, energy, and commodity markets. A scene from Wall Street, the movie, the advent of computers and technology coming into financial markets started to change the way that we managed prices displayed on a computer screen and the way we started to manage orders and process orders. And this, where a lot of financial markets trade now, is LD5, the data center in Slough. And there you have some of the world's biggest trading firms with their trading algorithms sat in the data center as close as possible to where the matching engine is and where financial markets operate. So the point of this is technology has always had an important role in financial markets, and it's always changed the way that we operate as a global marketplace. However, ultimately, what's being traded is largely the same. We're still facilitating risk, we're still getting products from producers to consumers, and we're still helping capital to form around endeavors like the formation of companies. And then along comes crypto. So, when we're talking to our client base, they see this as another asset. It's something that they want to hold, they want to be involved in, and from that perspective, it does look like another asset class that we, as a financial, energy, and commodities market, should facilitate the same sort of exchange and trading as we do in other asset classes. However, this asset class has some unique and interesting properties that we don't see in some of our traditional asset classes. So an example of this is around capital formation. So one of the things we saw in 2017 around the ICO boom was potentially a new way facilitated by blockchain technology of capital formation. Anyone with a digital wallet and an internet connection could coordinate capital around a project or an endeavor. That wasn't possible before, and it's very interesting as a property and a technology, and potentially something that traditional financial markets can learn from. Likewise, we've seen some innovations in crypto around trading, automated market makers, ways to bring buyers and sellers together, price discovery, and enabling trade. This is something, again, that we haven't traditionally seen in financial markets, and it's properties of crypto and blockchain which potentially are very innovative for the way financial markets operate. Likewise, risk. Now, risk is a very topical at the moment, considering the backdrop of what's going on at the moment. But I talked earlier about settlement times. One of the biggest risks that exist in traditional financial markets are around trade and settlement. Between that period, you're exposed to counterparts. You have credit risk. Historically, this has shortened. We started with T+7, T+9. Many major markets moved to T+2 in recent years, and there's talk about moving markets to T+1. Crypto, as we largely know, has much shorter settlement cycles. In general, it's much more immediate. It can happen over the internet, and these things happen in minutes, hours, depending on settlement finality, how long you want to wait on number of block confirmations. But at its heart, this product and this technology operates on very short settlement cycles, and that's very powerful from a risk perspective, and certainly something that financial organizations are looking at. So, what does this mean for traditional financial markets in general? You have this new asset that our global client base are starting to look at, want to be involved in, but it also carries these unique properties that potentially could be utilized across some of our traditional markets. And I think the important thing here is the token, right? The token itself, this is a primitive, a new product that is abstracted away from ultimately whatever the underlying asset is. It's a structure that can be applied to multiple forms of value, whether that be dematerialized real-world products like commodities, whether that be legal contracts around equity ownership, whether it be legal contracts around bond issuance. But this token, the genie's out of the box. That it exists. It's something that we now have available to us. This slide, credit to ARK Invest, who put it out in their Big Ideas 2022. But the analogy here being the internet, and how originally when the internet came around, people thought that it was a different channel alongside radio, TV, newspaper. And what we found as the internet evolved was that actually it's facilitating all of these channels. You have online radio, online TV, online news, but ultimately the internet is the backdrop below that, the distribution for each of these different things. Likewise, public blockchains, the way I think an emerging school of thought across finance is that this is a new technology on which various different asset classes can sit. We have crypto, and that's its own new asset class, but we also are seeing a lot of innovation from different traditional financial firms, technology firms, looking at replacing the base layer technology on which our asset classes sit and potentially moving this onto public blockchains. So potentially a way to finish this talk is, rather than thinking about crypto, is this just an asset class? I think it's worth stating that potentially crypto is every asset class. It's the technology that we can use to improve financial markets. But just given the backdrop that we have currently, I think it's also important to say that there are maybe some things and experiences we have in traditional financial markets that maybe potentially can improve crypto as well, around corporate governance, risk, separation of roles and responsibilities, and ultimately potentially the new financial system will be built out of a mix of crypto and traditional financial organizations working together. Thank you.
I love how you have a disclaimer. I think that's the first disclaimer I've seen in a presentation. Typical traditional finance.
Highly regulated financial institution.
Of course. Yeah. Hey, I'm interested to know, you have a traditional business being ICAP. How do your clients look at crypto, the traditional clients? Are they quite savvy? Have they got on from basically buying and selling Bitcoin? Are they staking, yielding? How experienced is the traditional type client now with regards to crypto that you're seeing?
I would say knowledge-wise,
yeah.
There's a huge amount of knowledge there. Not many firms have been active historically, but that doesn't mean they haven't been looking at the asset class, educating themselves. I would say depending on the profile of organization, market makers, hedge funds, people with a bigger risk tolerance,
yeah.
They're in there, they've been trading it, and the first step is Bitcoin, Ether's a less of a step, and then it becomes incrementally easier to move into other asset classes. Bigger organizations, banks, asset managers, they just have more change processes, approvals, regulatory hurdles to get there, but they're coming.
They're coming.
Yeah, and what we see across the industry is a move into it. It just happens on the timescale of years rather than months.
Of course, of course. Well, thanks very much, Duncan. That was an excellent presentation. Thank you very much.